Hi friends, in today's video we are going to discuss the financial management paper review along with the suggested answers. Yesterday your exams got over. I hope all your exams went really well. You would be in the rest period as of now, so take good amount of rest, and then we'll have to again come back depending on whether you're written one group or two groups. But okay, in today's video we are going to discuss the suggested answers as well as a quick review of the FM paper. I'll not take more than 20 minutes in this video. First, paper was a relatively simpler one, but two three things. One, it was a reverse working dependent paper. So reverse working means they'll give you the base information and tell you to calculate. Is called forward working. Reverse working means they'll give the solution, and from the solution you will have to come back to the original data, which is rarely tested in exam. But this paper was predominantly that. I think I could see three questions. One was a 10-mark question, two 3-mark questions, and again leverages had some reverse working. There was good amount of reverse working element in this paper. So reverse working element was there, but otherwise the paper was fairly simple, straightforward. The reverse working element could have become a challenge for few students to handle. And I've been telling students that you do your block method of preparation and you look at this. Block 1, cost of capital, capital structure, leverages, dividends. We expected 27 marks in exam and we got 27 marks in the attempt. Theory areas, I told you to pay special attention to chapter 1 and 2, anticipated 10 marks, but with the internal choice, it was 12 marks in exam. And in this also, chapter 1 and 2 came for 8 marks, and the other chapter came for I think chapter 8 was there, but otherwise this was theory element would have been easy. And for theory I had shared some summary notes, and there was a detailed video of 2 hours where all theory questions were discussed. If you had gone through this, you would have answered the theory element in case you struggle with the practical area. And from our priority material which we have released, the top 120 material, 57 out of 62 marks are covered. Obviously reverse working is covered, but the forward working questions were there and you will have to handle the reverse working question. So if somebody has gone through the top 120 question material here, and when he did costing also top 160 material, they were very useful to secure marks in exam. Block 3, anticipated for 15, turned out to be 16. And investment decision I anticipated only for 11 marks, and it turned out to be only 7. These were the breakup of the paper. And looking at this, we have again got it right. I got it right in costing, I got it right here, as well as in CA final AFM. And I feel any student who's doing the preparation for the later set of attempts should follow this block method. The blocks will not change unless I see the trends changing significantly, which did not change in this attempt. I don't see it changing even in the next attempt. So this is what you should do. Focus on cost of capital, capital structure, leverages and dividend, then the theory areas, then ratio analysis and working capital. And this was the paper breakup. And I will say it was a fairly simple, straightforward paper, except for the reverse working element, which some students could have struggled. Broad review is done. Let's now go through question. Question 1 was on approach with taxes. They have given the value of unlevered firm. With the unlevered firm, add amount of debt into the tax rate. This will give you value of levered firm. They have asked for value of equity. Value of equity after modification. Value of equity is equal to value of levered firm minus the amount of equity. This was, I think, a 2-mark question. So you add this and deduct the debt component. You get the value of equity. A fairly simple, straightforward question. Second one was on equated annual cost computation, EAC computation. For EAC, you'll have to write the cash flow, get PV of outflow, and divide by annuity factor. Year 0, outflow 1 lakh, then 1 to 5 years, 20,000 outflow. At the end of 5th year, inflow. Inflow, I'll write it as negative to reduce the outflow value, or you can write outflow as negative and the total can be a negative. It doesn't really matter. Year 0, 1 lakh, 1 to 5, 20,000, and salvage value is an inflow, negative 10,000. This will give me PV of outflow divide by the annuity factor, and you'll get the EAC 47617. Again, a question which is easy to secure marks, I felt. Question 3, this was on ratio analysis. I think the easiest of the lot, but this came for 1 mark only. Your current ratio is 2.5 times, which means current asset is 2.5 into 1 lakh 60, which is 4 lakh. Quick asset is 2 times of 1 lakh 60, 3 lakh 20. Gap is the stock figure, which is 80,000. Gap is the stock figure, which is 80,000. This is on question number 3. Question number 4 was a reverse working question. I really like this question. I think ICAI has drafted this really well. Reason I like this question is there were no mistakes in the question, because I normally see ICAI making mistakes in the question. I am very happy that there was no mistake in the question. So we will quickly solve this so that you get grip on this question. Even later on, some students sees this. This is a good question. Nice problem they have given. They said number of working cycle is 3, amount of working capital after contingency. So amount of working capital is 101 850. This is after contingency. Before contingency figure is this divided by 1.05. I'm removing 5%, and number of cycle is 3 times. Working capital is equal to, the formula is working capital is equal to cost of sales by number of cycle. Cost of sales by number of cycle, 97,000 is equal to cost of sales by 3. Cost of sales is 2,91,000. That's all. This was the important part. From this 2,91,000, opening stock is 31,100. Closing stock is 31,100 minus 4,200. We write this on the cost sheet. Raw material opening stock given, closing stock is given. WIP 20,500 minus 1,800. Wages is given. Selling expense. So from the COS, if you go back in the reverse order, 261 is COGS. From 261, if you adjust opening stock of FG and closing stock of FG, you will get COP. From COP, if you adjust opening WIP, closing WIP, you will get gross works cost. From there, if you subtract wages and manufacturing expenses, you will get raw material consumed. So you see here, started with 291, 261, adjusted inventory 256, adjusted WIP 258, adjusted wages and manufacturing, raw material consumed, opening stock, closing stock is given, purchases, balancing figure. With this, problem is over. With this, the question gets over. The real tricky part was how do you get the COS, and then in the reverse order, profit and sales and all was not given. So in this order, we complete it. They ask for raw material storage period, average raw material by raw material consumed. WIP, average WIP by COP. Creditors payment period, average creditors divided by credit purchases into 360. Debtor is balancing figure. How do its balancing figure? Operating cycle is equal to raw material plus WIP plus FG plus debtor minus creditor. What is operating cycle? 3 cycles in a year. 360 by 3, 120 days. Raw material you calculate here. WIP you calculate here. And FG I think you will calculate here. Creditor is calculated. Debtor is balancing figure. Raw material, WIP, FG, debtor balancing figure, creditor and operating cycle in days. These were your answers. To quickly check your answer, first one is 65 days and 30 days. Creditors payment period 63 and 48 days. Total operating expense 291 and 261. COP 256 800 and 40 days. And last one 145 800 and 149 550. I am not discussing that much in depth, but yeah, the main part is using the 3 cycles. You'll have to reverse work and get to the answer. This is on the MCQ part. Students could have struggled with the working capital question. Okay, then comes the descriptive part. First one is fairly simple, but there is one challenge. You will understand the challenge. They have asked us to calculate cost of equity using Gordon's model. What is Gordon's model? Gordon's model says P naught is equal to D1 by KE minus G. KE is equal to D1 by P naught plus G. Normally for cost of equity, we deduct flotation cost. Gordon's model is the formula that P naught minus F is used whenever I make a new issue. Not sure what ICAI is going to consider in this answer. I have given two answers. One without considering flotation cost, second with considering flotation cost. So it can be 2 rupees into 1.05 considering growth divided by 60 or 56 plus 0.05. This is cost of equity. Cost of preference is 8% of 100. 8 on current market price. The issue price is of no use today. Today's scenario 8 by 55 into 100. So 8.75, 14.55 or 8.5 and 14.55, and WACC equity market value weights. Equity is 1 crore divided by 10 into 60. Preference 5 crore divided by 100 into 55. This weights will remain same, be it rework or this, but there can be a change on the cost of equity. I have given two answers. Reason is very simple. There can be multiple points. I feel ICA will give this answer, that is in considering flotation cost. There is a possibility they may give even without considering flotation cost, because the word Gordon model is specifically used there. This is question 1. Question 2, a ratio analysis question. This was there in our material. Exact same question is there. At least the earlier question. Earlier was a concept related question. This is exact same question is there. It says we are planning to do a sales of 55. Direct cost is 30. GP 25. Expenses 4.8. This will give you EBIT. After operating expenses, you will get EBIT, which is 20 lakh 20,000. Interest cost is 50 lakh, 35% of asset, 35% of asset into 10.5%. 50 lakh into 35% of asset into 10.5%. Deduct that. Tax rate is 33% and earning after tax. Straightforward question. The question has asked for profit after tax, net profit after margin after taxes, EAT by sales into 100. Return on asset is EAT by total asset. Total asset is 50 lakh. Asset turnover ratio, sales by asset. Return on equity, EAT by equity. What is equity is, of the 50 lakh, 35% will come from debt, balance 65% has to come from equity. Balance 65% has to come from equity. These are your answers. PAT 1230, net profit margin 22.37, return on asset 24.61, asset turnover ratio 1.1, return on equity 37.85%. 1C, there's a similar question where a lot of adjustments are there. This had very limited adjustments. So this was a straightforward question. But yeah, some adjustments, some good questions were there. First point, existing machine was purchased 5 years ago for 16 lakh and has a life of 10 years. 10 years means every year depreciation 160. So today the book value is 16 minus 1.6 into 5, 8 lakh. Sale value is 9 lakh 60 today. 960 minus 8 lakh, there will be a capital gain. On the capital gain, you have to pay tax. On the capital gain, you have to pay tax. On the capital gain, you have to pay tax, and there will be an NSV. So 960, 80, capital gain, tax paid, and net salvage value. This is the value I'll get by selling the old machine. 907, 200. I'll get 907, 200 by selling the old machine. By selling the old machine, we will get 9,07,200 rupees. 9,07,200 rupees by selling the old machine. New machine purchase price is 32 lakh. This is taken care. In between flow, one is contribution will increase, which is 2 lakh 40. Inflow, savings is also inflow. From this I subtract, there's no other expense given. Depreciation, extra depreciation, incremental. Old machine is 1 lakh 60. New machine is 32 lakh minus 3.2 lakh divided by 5 years. 32 minus 3.2 divided by 5 years. That difference is called incremental depreciation. PBT less tax, PAT add back depreciation CFAT. So you can see the calculation here, 240, 320, extra depreciation, PBT, tax, PAT. This is the extra inflow every year. 1 to 5 years we will get this inflow. Then there is a terminal inflow, which is by selling the machine after 5 years. Existing machine, no data is given, so no salvage value. New machine you can get 3,20,000, and you consolidate this and calculate NPV. NPV is negative, project is rejected. Should not do replacement, as the NPV of the replacement decision is negative. NPV of the replacement decision is negative. Cash flow computation is straightforward, simple calculation. Similar questions are there in our material, where in fact we have done more adjustments. Here only lesser adjustments are there. Question 2a. Question 2a on leverages. On leverages, reverse working question. I have equity capital 12,500 share. Debentures is there. 8% bank loan question mark. I have total sales, so we'll write it side by side. Sales 75 lakh. Contribution 30 lakh, 40%. Operating leverage 2.4 minus fixed cost EBIT. What is operating leverages? Contribution by EBIT. So EBIT is technically equal to 30 lakh divided by 2.4. 30 lakh divided by 2.4. 12 lakh 50,000. Fixed cost balancing figure 17 lakh 50,000. Answers part 1 and part 2 of the question. Amount of bank loan and bank interest, less interest, EBT. How can I get EBT? Using combined leverage. What is combined leverage? Contribution divided by EBT. So combined leverage, combined, no need to do even financial leverage. Contribution by EBT, 3.84 is equal to 30 lakh by EBT. EBT is equal to 30 lakh divided by 3.84, 781 250. EBT is 781 250. Deduct tax, you will get EAT. Deduct tax, you will get EAT. Divide by number of equity shares, you will get EPS. Multiply with PE ratio, you will get MPS. EBT, deduct tax, EAT, divide by number of equity shares, EPS, multiply with PE multiple, MPS. Interest is balancing figure. Interest is balancing figure, 12,50,000 divided by 781 250, 468 750. 468 750 is the interest figure. 468 750 is the interest figure. In this 468 750, I have already interest on debenture, which is 3 lakh. Balance is bank loan interest 168 750, and divide by 8% is amount of bank loan. So a good question, but this type of reverse working we have already done a lot of questions in class, so this I don't see as a big challenge. Okay, other reverse working can be a challenge. So 43.75 and 350 is the EPS and the MPS. I really liked this question from ICAI. This is a reverse working question where they have given market price as per Gordon model. This some student would have struggled. 159.09 is equal to D1. What is D1 is EPS into 1 minus the retention ratio. Retention ratio is normally called as B, divided by cost of equity minus growth rate. Growth rate is IRR into retention ratio. Growth rate is 0.12 into B. So the equation is 159.09 into 0.08 minus 0.12 into B is equal to EPS is 5 lakh by 50,000. 10 into 1 minus B. We'll have to solve this. 159.09 into 0.08 minus 0.12. I think you will get a retention ratio of 30%. Payout ratio is 70%, 7 per share. payout ratio 70%, 7 per share, payout ratio 70%. Dividend is 10 into 1 minus retention ratio, which is technically payout ratio, and denominator is IRR into retention ratio. IRR is given in the question 0.12, retention ratio. What will be the, if both are equal, no optimum payout ratio, indifferent, you can pay any amount of payout ratio, any amount can be paid. If R is equal to KE, you can pay 1%, 10%, 20%. We are indifferent. We are indifferent as far as the second part is concerned. Question 3A, exact question is there in the study mat as well as our material as well as in the top 120 question material. I think exact question. The CFO wants to raise funds of 22 lakh. Current estimates are EBIT is going to be 5 lakh straight away given. Share is currently 120 but will decline to 110 in case you borrow more than 10 lakh rupee. In case you borrow more than 10 lakh rupee. Cost of debt will be 14% up to 8 lakh, 16% for another 2 lakh and 18% for additional. 60% in debt means 13 lakh 20 debt, 8 lakh 80 equity. 50% means 11 lakh debt, 11 lakh equity. 40% means 8 lakh 80 debt, 13 lakh 20 equity. The equity portion in the first one will issue shares at 110. We are borrowing more than 10 lakh. Last one will issue shares at 120. First two at 110, last one at 120. Interest cost is first 8 lakhs into 14%. Next 2 lakh, if you take another 2 lakh into 16% and balance at 18%. So interest cost will be calculated 8 lakh, 2 lakh, 320, 13 lakh 20, 8 lakh, 2 lakh, 1 lakh, 11 lakh and 8 lakh and 80,000. This is how interest cost would be computed by us. After the interest is computed, number of shares is computed, you put it in the EBIT format. EBIT, interest is computed earlier. EBT, deduct tax. EAT, no preference dividend. Yeah, okay, the conclusion is missing here. We will go ahead with alternative one. The question wanted, I think, the conclusion. Considering which option of financing, I should have written that. I missed it. We will go ahead with alternative one. We will go ahead with alternative one because that is the one which is maximizing the earnings per share. Straightforward, good question. Okay, last question, again a reverse working question. Here they have talked about a redeemable debt approximation method. Answer is given, which is 0.1458. Approximation method is interest after tax. Interest is 18 into 0.7. Average other cost is redeemable value 100. Issue price is net proceeds A. Life is 8 years. Denominator is 100 plus A by 2 plus A by 2. 0.1458 is equal to 18 into 0.7. 100 minus A by 8 divided by 100 plus A by 2. You will have to solve this. I think you will get A as 90 and then get the cost of debenture using approximation method. What is approximation method? And redeemable at 10%, the rework scenario. If it's redeemable at 10%, cost of debt is equal to 18 into 0.7 plus 110 minus 90 by 8 divided by 110 plus 90 by 2. 110 it will become minus 90, 110 plus 90, 15.1%. That's all. Then fourth question is a theory question which could have been answered with the summary theory itself. From the important chapters was 4B, 4C and 4D. Now unimportant chapters, we did not think dividends chapter question will be there. There was one question from that area. With this, my discussion gets over of this paper. I feel it's a fairly simple, straightforward paper except for the reverse working element. Do share your comments. Also, let me know how many marks you're scoring in the MCQ. And for the future attempts, any kind of help you need, any assistance needed from my side, do comment on the chat box. I'll try to cover all those areas. Thank you, friends.